Hello and welcome to BST Live. Glad you could join us today. Today we're going to be talking about AI, that's artificial intelligence in trading. Let's get to it. Welcome everyone. Good morning, good afternoon, good evening, wherever you are. Apologies for the confusion about the time starting there. We just managed to get that at the very last minute. So thank you to everyone for holding on and understanding there. Now, today, as I mentioned, we're going to be talking about AI, and that's artificial intelligence in trading. And we have a trading legend expert with us to discuss that. Now, we're joined by Mr. Bob Pardo from Pardo Capital. You've probably heard of Bob. He's a legend in the industry. He has won numerous trading awards, both personally and for his fund management. He's the inventor of walk forward analysis. He's been an industry veteran for over 40 years. So he's seen a lot of things come and go, including AI. So it's going to be really interesting to pick his brain and see what he's discovered over the years with artificial intelligence and where he thinks it's going. So welcome, Bob Pardo. Great to have you here.
Great to be here. One of my favorite subjects.
Yeah, exactly. So I know you've been looking at AI since the 90s, so I think you've got a lot of interesting stuff to share with us. But first of all, how are things going in Chicago? I know you're coming to us from Chicago. So how are things over there?
Things are good. You know, we're actually holding our own on the COVID front. I'm actually having a good time with my business, with the new products and the strategies and developing new things and digging further into AI and into more sophisticated robotic trading techniques. So I'm keeping my plate full.
Yeah, exactly. So yeah, let's talk about AI because I think it's a very interesting field. We're seeing a lot of applications of AI in real life scenarios. For example, image recognition. We're seeing a lot of it being used in Facebook and a lot of social media platforms. Movie recommendations, like in Netflix and things like that. So perhaps you could tell us a little bit more about how it's used in real life right now outside of trading, and then maybe we'll tackle trading next. So can you tell us more about AI and how it's being used right now?
Well, there's a whole lot of areas where it's being used. You probably know that in the medical field, they've been a pioneer with expert system development. The kind of thing you're talking about with movie recommendations, that could well be expert system stuff. I have a client friend who actually is he's a software developer, and you speak of facial recognition. He trades. I've talked to him about using AI and neural nets in trading, and he maintains that the neural nets, to really be effective, need lots and lots and lots and lots of samples, millions upon millions of samples. And that the way he's looked at the data, for example, you can't get enough. But conversely, I have a person who approached me about helping him with some of his trading products. And he had something very dear to my heart, some very interesting support and resistance lines. And so as we've been talking, he explained to me that he actually uses a neural net to come up with one of the key points, and then some ordinary calculations to come up with the support and resistance points. But interestingly, the numbers are damn good. So, I also work with my client about trying to use neural nets to look at patterns. And that's where neural nets really stand out. So, you asked the question, how are they really being used in trading these days? I mean, to a large extent, the most that's being used, was really mostly being used in trading, is forecasting stuff. I mean, it's out. If you know a little bit about neural nets, you know that they're bound to be a better method of prediction of price action than your standard line of regression, since they have way more inputs and way more efficiency in terms of reacting to different kinds of currents in the data. But that's one area where that's one of the biggest areas where it's being used. People talk about robot trading, and I think it's kind of like a glorified term, because really what robot trading really is what is coming to the public now. But robot trading has been, what they call robot trading, actually has been done by hedge funds for a long time.
Yeah.
And really, what it boils down to is they look at lots and lots of markets. They have a method of coming up with prioritizing the most efficient markets to trade. They sometimes have methods for prioritizing the quality of the trades. They look at markets. They use algorithmic techniques to balance their portfolio. They use algorithmic techniques to pick their markets. So I mean, and they really are trading on. They are really trading by computer. But to really call that artificial intelligence, I wouldn't call it that. I wouldn't even. It's certainly automated trading at a high level, automated portfolio balancing, automated this, automated that, but it's not artificial intelligence.
Okay, so I'm going to ask you a little bit more about that statement in a sec. But so it sounds like, from what you were just mentioning there, that is there really only two areas where AI can be used in like the strategy development and prediction side, and then also portfolio management? Is that a good understanding of the two key areas where AI can be used?
Well, I think AI can be used in other areas besides that. I mean, I think that what's happening is because a lot of the attention in artificial intelligence development has been on forecasting and pattern recognition. That's really those kinds of algorithms are pretty well developed. So adapting them to trading is somewhat straightforward. Of course, I've always but I honestly feel that the place where it's not being used, and when you think about where it's not being used, is trying to actually replicate all of the inputs that happen in the mind of a good trader. Because all you have to think about is the fact that if you're a trader, you kind of know off the top of your hat that there's an election coming in the U.S. You know that the stock markets have been hyped by huge amounts of money flooding into the markets. You know that a lot of things. You look at a lot of kinds of patterns. You know what the other markets are doing. You know what crude's doing. You know what interest rates are doing. There's a lot of inputs that are just in the mind of a trader. So that if they're following a strategy automatically, perhaps even, and all of a sudden it goes off the rails, they may think to themselves, well, that I understand why it went off the rails, and I'm going to I'll have respect for that, and I'll shut it down right now. But there's a lot of, and I personally feel that I think when artificial intelligence begins to embrace the kinds of overall patterns and mindsets that a competent trader has when they're trading, either with discretion or even managing strategies that are algorithmic, then we're beginning to do what people are worried about. In fact, we're actually going to be coming up with complex sets of interacting algorithms that actually can begin to emulate the quality of decisions that a sophisticated trader can actually do.
Yeah.
Makes sense.
Yeah. So when you just said previously about hedge funds have been using AI for years, but you really think that that's more just automated trading. Obviously there's a difference there. Is that the difference you're talking about with the being able to adapt with all these external inputs?
No, I think that what's really happened is that there's the robotic trading has been going on at a high level for a long time. Robotic trading is beginning to trickle down into the domain of the retail trader, and I can't say for sure whether or not nobody's actually really doing this, because I think that probably there are some people that are doing it, but they're keeping a really low profile. So I think what you have to look at is everything that goes into the expertise of trading, and then you have to begin to really try to model all of that. And like we were talking before, I personally think that one of the things that will be really helpful in this area will be the use of really highly customized adaptive expert systems. Expert systems they really are designed to incorporate all the data that goes into a knowledge domain, and then they know how to reason with that logic domain, with the rules that are programmed into it. I mean, the reason why they're not being more widely used is because they're really expensive and they're really hard to build.
Yeah.
It takes a lot of expertise to build one of them. And plus, you really have to say, if, for example, somebody would say, I'm going to these are the 100 best traders in the world. I'm going to pick their brains and put it into an expert system. You'd have something awfully good if you did it right. But part of the thing is we both know that traders are not exactly prone to share with their success and how they do things. So part of it, in the field of medicine, everybody's pulling the oars in the same direction. They want to help people. They want to cure people. They want to find a very inexpensive way to find the best solution. They use it like in the legal domain to search the legal databases. Yeah. So where you have when you have a consensus about how to actually what you really want to do, if people agree that they want to do that, they're willing to share their knowledge. But I mean, how many traders want to share their knowledge?
Not many. No. So this whole this challenge of inputs, which you were just talking about, what's the underlying issue there? Is it knowing what data to use, where to get it, how to use it? What's the underlying problem with the input challenge you just mentioned?
Well, I'm not so sure it's really it really ultimately, you think about it this way. What would you, if you were able to actually have a program that was monitoring virtually every market in the world and say 5-minute bars, 1-hour bars, daily bars, weekly bars? Think about what you're looking at. You're looking at probably tens of thousands of instruments, and you're looking at millions of data points. So there's a practical problem. And now the bigger firms, I mean, this started back in the 80s, and they started doing what they used to call program trading, which is really basket trading a basket of stocks against the S&P futures in an arbitrage. That was the first. People don't talk about it much, but that was the first real program trading. That was the first robotic trading, because no human. I don't care what kind of staff would you need to trade 500 stocks simultaneously with the S&P. You need a big staff. And so that was something that the computers could do that people couldn't do. D.A. Shaw, for example, they've been doing this for years. Renaissance Technologies, they do the similar kind of thing. They're looking at a tremendous number of markets, and they're looking for the best opportunities in those markets. So it's, on the one side, there definitely is clearly an issue of having all the data, and having sufficient computing power to actually bring it all in and put it into a manageable form. But there's the issue really of if let's say, for example, you're going to use let's hypothesize and say you're going to use a expert system that's going to actually use 10 different kinds of neural nets on 1,000 different kinds of markets. You're talking about a gigantic computing problem. And certainly, large institutions can afford it if they want to. But neural nets are computationally very intensive, and they're very demanding. And even though the computers these days are more powerful, I'm not so sure the apps are really up to it. So it gets to be there are practical concerns about the quantity of data input, the processing, all the processing power needed. So those are real practical concerns. I think part of what I would do when I'm brought to this challenge is I will certainly have to. You have to have a controller. You have to have a mastermind someplace. Looking at everything that's happening, and making decisions about where to focus your attention. Because ultimately, there's a lot of markets and there's a lot of data.
A
lot of opportunities.
Yeah. It's interesting you bring up this the processing capacity issues, because in the 90s when AI was taking off a little bit, and the processing speed was a concern then, and since then processors have grown exponentially, and memory and all that kind of, we've got a huge amount of computing power now, and now we still hear that it's not enough for AI because we need more power. Do you think is it ever going to be enough to get to AI nirvana, where we can just switch it on and it starts trading for us? Is that a possibility?
Yeah, sure it does. I mean,
Yeah.
and in fact, in small ways, that's happening now anyway.
Right. Okay.
It's kind of a matter of if you really, ultimately, I know we've talked about this before. I developed a concept years ago that I published in my book called Perfect Profit, and that simply tells you how much money you could make if you bought every peak, if you bought every valley and sold every peak.
Mm.
And when you look at, we looked at the S&P, for example, over 5 years, and the perfect profit then 5-minute bars was something like $15 million if you just traded one contract. And of course, it goes down as you go up. In the time frame, you have less opportunities, so you have less perfect profit. But ultimately, you really have to make your decisions about how you really want to actually play that game. And so I think ultimately that's where the controller comes in.
Yep. I was reading an article a couple of weeks ago. Now it was published on, I think, the Financial Times website, and it was talking about AI being used in portfolio management. And there was an interesting statement there that I never considered too much before, and was about saying quant funds are using these techniques, but they're all kind of using it the same way and finding the same edges. And do you think that's going to be a continual problem, or is it just the way that they're applying these techniques that they're all coming up with the same solution?
I think it's the way they apply the techniques.
Right.
You have to realize. I mean, I don't want to sound cynical about this, but a lot of people, Wall Street has a real herd mentality. They don't necessarily. You don't necessarily have a hotbed of innovation there. You just like Hollywood. What you have is a hotbed of imitation. So if they're all getting the same answers, that's because they're all using the same techniques. And ultimately, there's all kinds of ways to cook a portfolio. And if they're all getting the same portfolio mix, they're all using the same algorithms, and I wouldn't blame that on artificial intelligence. I blame that on the lack of human intelligence developing the artificial intelligence.
That's an interesting point you make, actually, because I guess a human has to direct the AI into what the goal is. Is it, do you want to make as much profit as possible? Do you want risk-adjusted returns? Do you want maximum diversification? Do you think that everyone's looking for the same thing, and that's what's causing it? They're all going for the same goal?
Well, I don't think there's any other explanation for it. In all honesty.
Yep.
It's just, a lot of people basically use they have the same kind of approach to portfolio management, and they're incorporating this in their portfolio blending and mixing, and they're going to get the same kind of results. But ultimately, even though let's just say you're going to look at the S&P 500. There's 500 stocks here, which sounds like, to a guy who trades futures, that sounds like a lot of instruments. But in the end, you probably know that even though the idea of a hedge fund originally was supposed to actually be a hedge against the stock market corrections. That was the original concept.
Yeah.
But as you probably well know, that's not what happened. Most hedge funds are highly correlated with the stock market because they basically play the long side of the stock market. And in reality, if you look at if you look at the data, for example, over the last say 12, 13 years, it's relatively difficult to get a good model that doesn't have a long bias, because there's been such a long-term bias and the upward trend in the stock market. And if you look at the stock market over a long enough time period, it's certainly just been an uptrend with some pretty big corrections in it.
Yeah.
So trying to find. So the point is, I don't trade stocks, although we're going to be getting involved with it, just because for capacity issues and opportunity issues. But I don't. It's hard for me to really believe that all the airlines, for example, aren't pretty closely correlated. So this is what you have to. This is part of the issue gets to be if you have 10 stocks that are all correlated 90%, 0.9, do you have 10 stocks or do you have one stock? So you can look at it from a point of view of capacity and so forth, but there's a high degree of correlation and all that stuff. So they're probably, it may have something to do with the fact that the opportunities there are maybe the opportunities are really kind of limited to the upside.
Yep.
Make sense?
Yeah, absolutely. We've got a couple of questions here in the chat. I might just get your opinion on some of these. So let me just put it up on the screen.
Sure.
This first one is from Al. G'day, Al. How do you teach a computer to follow the mindset of a successful trader? Do you use rule-based systems only, or is there a role for genetic optimization to search for strategies?
Well, ultimately, Al, like I indicated before, I think that you teach a computer to mimic a successful trader by using an expert system, which is a rule-based system. The things that we'll develop, we're going to have to have more than just a static database and a rule base. I foresee a need to have a place, for example, where we're actually looking at the 3-day pattern, the 10-day pattern, the monthly pattern, looking for patterns within that data, and then utilizing rules to evaluate the patterns that are detected outside of the expert system. So you talk about genetic optimization to search for strategies. I think that people are doing that. I don't know, from what I've seen, the results haven't been all that stellar so far. But that's no reflection on genetic optimization. That's more a reflection upon the application of it. So there's a place for that as well. And there's also a place for expert systems in the development of strategies.
Okay. Thanks, Bob. Here's another question. This one's from Ola. Just pop it up on the screen here. A daily time frame on one market will give you a small number of samples. You can get unlimited number of machine learning features. Will the info be skewed where you would say, sorry, I don't know what that means. With the info skewed, that where would you say is the threshold for usefulness?
Well, it kind of comes down to really what you're looking for. You can build. I mean, like I said, my client, who I have a great deal of respect for, maintains that there's just not enough samples in the daily frequency. But then you look at ticks, and there's a whole lot of samples. So you really need to fit your process to your objective, and then you have to look for if your process is to have 1,000 trades a day. Well, obviously you're going to need to have tick data. If your object is to simply jump on the big swings that last for months, well, that's a different kind of situation. So it really is. I don't know if there's a hard and fast rule. I mean, I know that for neural nets you need lots and lots and lots of instances, but I think there's a lot of ways to actually set up neural nets to look at different kinds of patterns and so forth, and perhaps then you don't need as many. I mean, I know we had a process years ago where we developed this for a client, a very large institutional client, and they just simply wanted us to look at, let's say a guy wants to look, you can say I want to look at the last 10 bars, and then I want the computer to search for any whatever the closest number of patterns like it that exists in the data going back, say 5,000 bars, and then make a prediction based upon whether or not it finds that there actually was a pattern that was higher than flipping a coin, or whether there's not. So there's a lot of ways to skin the cat. Let's put it that way.
Yep.
You have to fit your tool to your objective.
Yep. We've got an interesting comment here from Ilya. I'm going to put it up on the screen. Talking about the place of retail traders and institutions. Welcome, Ilya. I think Ilya's new. I haven't seen the name before, so welcome. Retail traders have edges that institutions do not. They can transact much more quickly and not impact the markets. Use that to your advantage. I think I was going to ask you a little bit later on, but maybe it's a good point to address now because of Ilya's comment. But if you got hedge funds and CTAs using these techniques, and they've got the brain power, they've got the money, they've got the computer processing power. Where does that leave retail traders and private traders using these techniques? Should we just stay away, or as Ilya mentioned, retail traders do have edges that institutions do not? So how can we balance the two? What should we be looking at for private or retail traders?
Well, I'd be curious to know what edge the retail traders have that institutions don't have. But let's assume that that's true. I don't think the institutions have always had an advantage over the average trader, the retail trader, the smaller trader. They've always had an advantage. They always will, because they always have the most amount of money. And they always have the ability to actually attract top talent. So they do have this. Now, granted, sometimes they don't have a lot of imagination, but they still can attract top talent, and they should be able to do better than the average guy, simply because of that. It's a huge advantage. But it doesn't mean, for example, that you can't find your own edge. I mean, the stuff we use is not based on anything, all that. It's not based on anything terribly exotic, and it works extremely well. There's all kinds of edges, and I think, just like they said, there's a million roads to Mecca. I think there's a million roads to making money in the markets. But you simply have to find your edge. And the simple truth is, you have to make sure that the most important thing is, if you think you have an edge, make sure you know you got an edge, and make sure it's thoroughly tested, and make sure you can afford it, and make sure that in fact that all the assumptions about slippage and cost and so forth are real, and then go for it. But I mean, people are making money in the markets who are not institutions for many, many years. And I believe they always will be. But you have to find your edge. And let's face it. I mean, the amount of sophistication that people have now, for example, versus what they had when I first started doing this. Yeah. I mean, it's a joke. I mean, but the irony is that even though TradeStation and a lot of these tools have come a long way and are very powerful. To me, it's ironic that after putting Walk Forward out there almost 30 years ago now, that people still don't deem it wise to use it all the time. I mean, I can't imagine building a strategy without Walk Forward analysis. I'd rather shoot myself in the head than do that. But people, I mean, I had a guy. There's a guy that he was very involved with. He was very involved with helping CTAs. And we were talking a couple of years ago. He's retired now, but we're talking a couple of years ago about what I had, and he asked what my process was. So I gave him the general outlines of my process, and he says, most guys do. They do an optimization. They probably have a crummy optimization. They get an optimization with maybe 50 things out of 1,000 tests that are profitable. And they think they've got something, and then they go for it. It's no surprise that no surprise that it doesn't work. So I mean, even though the computing power has come a long way, and the applications have come a long way, although as Andrew and I have both agreed, the applications have not kept up with the capacity of the computers by any means. Yeah. A lot of the things like MetaTrader doesn't have a Walk Forward analysis. I'm sorry. Yeah, that one. A lot of them just don't have a Walk Forward analysis built into it. TradeStation has it, but it's actually of a form that's. It could be better. Let's put it that way. So it's like anything else. If you think you have it, if you think you got something, build it, test it. Be sure you're right, and then go for it. And make sure you understand all the nuances of what's involved with running an algorithmic strategy, because it's not just finding one that works and then letting it run.
Yeah. AEW actually raised a good question that links to that. Let me put it up here. Will we ever reach a point where retail traders cannot find edges that last long enough to exploit?
Well, AEW, who knows? I doubt it. Ultimately, I don't doubt that. Probably, I don't know how long it will take. I don't doubt. I know that people are saying right now that AI is a serious danger to civilization. And I would agree. I mean, but I think we're fortunately, at least for now, we're at least we're a few years away from the Terminator. But I think it's only inevitable that people will figure this stuff out. I mean, I'm not the first guy that figured this stuff out, and I'm sure other guys will. And I think that it's not inconceivable that 20, 10, 20, 30 years down the road, people won't really have to do much of anything in terms of supporting themselves or producing anything, and they can just be free to be people, as opposed to being robots in a system like we have now. So who knows? I don't know. Ultimately, I do think. Let's put it this way. Computers are going to keep on getting faster. Storage capacity is going to keep on getting bigger. The ability to download is going to become just going to keep on getting faster. Yeah. It's not going to. None of that's going to go away. None of it's going to go backwards. So ultimately, I mean, people will begin to fully. Eventually, applications will develop that will actually utilize all the computing resources that are out there. And I believe that ultimately AI can be harnessed to be extremely good for all of us, and it can be harnessed to really handle the markets. But then you really have to ask yourself the question: if we are living in a civilization where people don't really need to work to support themselves anymore, and people are really the interest in money is not, as this may sound to Westerners in this day and age. Interest in money is going to dwindle, because if you can have all the money you want, just because you ask your computer to give it to you or find a way to get it for you, and it works, who cares about money anymore? If you can manifest gold out of just like that, how valuable is it? So I think you really have to, I do believe that at some point in time we are going to have a more peaceful application of artificial intelligence. I mean, you probably are aware of the fact that one of the biggest areas of robotics in the United States is building killing machines. Well, okay, that's all well and good, and they're actually, some videos I've seen, they're unfortunately pretty damn good. But there are better uses, in my opinion, than that. And there'll be and I think we all need to focus our energy upon finding better ways to put this kind of incredibly powerful technology to use to help people as opposed to kill people.
Yeah, it's pretty frightening when you think about the possible consequences of all this. But I hope, as you mentioned, that we find more peaceful and better ways to use these techniques.
It's in your hands.
Yeah, a follow-up question from AW. In your experience, has the lifespan of edges been getting shorter and shorter in recent times?
No.
It's funny because there's two schools of thought there. Some people are saying you need to get in shorter, and others are saying you need to extend the time frame and get away from the noise. So you found that shorter isn't better?
I built some programs. I built them in 14. We actually built them and started running them on paper in 14, and they did extremely well, because I wasn't putting that stuff to use. I hadn't looked at it for a couple of years. For reasons entirely unrelated to the strategies, I had to load one of the workspaces, and we had like 40 different strategies in the S&P, and I loaded the workspace that had all the strategies, and I didn't even. They're all walk forward techniques. They're all based on walk forward analysis, so they all would benefit from having their walk forward parameters updated, where you're supposed to update walk forward models, and that wasn't even done. And I was very pleased to see that. I think about 30 out of 40 of them did extremely well. So in other words, I certainly, what you will see if you trade long enough and you have enough strategies, you will see that there's good weather and there's bad weather. There's some you have markets that are really moving, and if you have a market that's really moving and your strategy doesn't make money, you better go back to square one, because that's the key to success in trading. You want to be involved with a moving market. You don't want to be involved in a flatline market. So ultimately, I, to compound this whole story, those strategies ultimately were all evolutionary. They were all ancestors by maybe 4 or 5 generations of a strategy that I built actually back in 1993. So I don't think. I think. Conversely, I know that when I was selling software back in the '80s, I sold software to that's when they still had floor traders, and I had a lot of customers who were floor traders, and I had a guy who had my software. We became friendly, and he fell on hard times for him. I mean, his hard times wouldn't be hard times for most folks, but for him it was hard times. And he said, I lost my edge. So there are times when people come up with, certainly guys involved with, shorter term trading, looking at it from the perspective of what the floor trader might look at, or even trying to seeing some aberration that actually has been very, very lucrative. Yeah, those can die.
Yeah.
But I think if markets move, when markets move, you should be able to make money with all kinds of different techniques. So I think you have to look for. I personally believe that edges that expire very quickly may not have been extremely well tested. I don't know, for example, whether it was actually developed on 10 or 15 years of data, or it was just developed on 1 or 2 years of data. But ultimately, if you build your data strategy with enough data, and you have enough trades, you might have a more persistent edge.
Yeah. Question here from Remy. Let me put it up on the screen. How difficult is it to create a viable adaptive trading system which will take simple decisions based on recent data? Have you done any work in this adaptive approach?
Yes, and it depends on the strategy. Ultimately, if the strategy is extremely complicated, I think making it more adaptive probably is more difficult. But if you have a strategy which is reasonably straightforward and not that complicated, I mean, like if you have a cycle, let's take an obvious example. You have a strategy that somehow exploits short-term trading cycles. Well, you can have if you do an optimization, and you find that let's say the 10-day cycle is the best overall cycle. And overall that may work very, very well. But the simple truth is, I'm willing to bet that if you actually build something in there which would actually detect the short-term cycle relatively accurately and use that parameter, you probably do a little bit better.
Yeah. Another question here from Al. We're getting lots of questions here, so I'll post a few more. How best to find these longer lasting edges that you were just speaking about a minute ago? Give us a secret sauce.
I don't know if it's sort of like people, how do you find these longer lasting edges? I mean, I don't know how much you've looked at this stuff. I mean, I've been doing this for a long time. Before I started building trading strategies, I built software that actually had a vast number of different kinds of indicators and a vast number of support and resistance techniques. I looked at lots and lots of trading strategies based on all these different ideas. And frankly, I have things that I know I have things that I still haven't used that I know would be effective. So it's just to me, it's just a matter. I mean, some people are prolific at this. I don't know why I have an edge at this. I guess I'm just very stubborn, and I'm just very curious. I'm always looking for new stuff. I mean, because to be honest, I bore kind of easily. So if I can't find something new and interesting to look at, I just keep on looking because I want to find something that's interesting. And there are a lot. When I first started doing this, there weren't a whole lot of books out there about this. Now there literally, there may be thousands of books about this. I don't know. I've got I've got a few hundred of them sitting on my bookshelves right here to the left of me. So I mean, but the point is, you really have to look like an artist. The training of an artist is that they master the art of the masters that preceded them. And I think that the scientist doesn't the engineer doesn't reinvent the wheel. The scientist doesn't start from scratch trying to figure out quantum mechanics. They master the art of those who preceded them. They master the art of the masters that preceded them, and then they build from there. So I think it's the simple truth is, if you're trading is prediction. It's an art, it's a science, and if you don't pursue it scientifically, you're only have yourself to blame for the consequence, because the consequence is going to be you're probably going to lose money. So I think you just kind of owe it to yourself to be unbelievably relentless in searching out new ideas, and just testing every idea that you ever see that makes any sense to you, and then seeing whether, if say for example you test an idea that makes some sense to you, and it looks like it might be kind of okay, but it's not really good enough. Well, then it's up to you to kind of to see whether or not, by adding a filter, or by adding a regime filter, or by adding a target, or by adding a risk stop, or adding a volatility filter, whether it makes it any better. So it's just like in our product Ranger, you can start with something very, very simple, and you can build something where you're looking at really something very complex with targets and stops and trend filters and cycle filters and volatility filters. The sky's the limit when you have something adaptive like that. And I would suggest, if you haven't done that, then you should probably incorporate that into your development process.
Yeah. I know with your trading, you like to use, I guess you could call them market truths or market observable behaviors, and put a little twist on them. Put your own unique or Pardo twist on it to give it a new lease of life. Do you think using AI and machine learning techniques kind of not avoid that, but they miss the opportunity there by you looking at the markets in that way?
Well, if you're talking about using computers to blindly create new strategies, yeah, I think it can all kinds of opportunities. Ultimately, I think with you, because I remember, when I worked on a project for Goldman Sachs in the 90s, and I built a lot of things. We adapted one of our programs for their in-house use. We built a lot of stuff to add onto it. That's in those days, like I said, I've always been interested in artificial intelligence, and in those days, neural nets were the hot item. So I said to my guy there, I said, "What do you think?" And his name was Andrew, coincidentally. And I said, "Andrew, what do you think about neural nets?" And he said, and he was a very, very sharp guy, And he said, I know that they hold a lot of promise, but ultimately we can't use them because we have a fiduciary responsibility to know why we make a trade. And I think when you basically, I think that, for example, if we robotize, because we kind of do anyway, if we kind of robotize the process we use for developing strategies, and with Ranger and the other stuff we have, it would be, let's put it this way, in the process of robotizing that, we're not going to throw away the baby with the bathwater. If we find something that actually, let's say we've looked at 1,000 possibilities, and 150, 200 of them are actually showing promise, and of those 200, 50 of them are lights out great, 100 of them are good, and 50 of them are so-so. Well, you want to throw it all away, or you want to be aware of it. You want to be aware of all these things, because you never know what you can do to actually kind of take the ones that are so-so and make them very, very nice. So I think it's really important to really be aware of the logic behind your trading stuff, and be aware of why you're adding these things to it. You want to know, for example, that if you try 10 different kinds of trend filters, and only one of them makes it, let's say you try 10 trend filters, and one of them is absolutely great, and 9 of them absolutely stink. that to me that makes me a little bit anxious. So I'm not saying I would reject one that was actually outstanding, but I wouldn't be as happy as if all 10 of them, they may not all be great, but they may be okay and they may be good, and they're not awful. So I think it's those kinds of things you want to know when you're doing development that you don't know if you're doing it in a completely automated fashion, at least the way it's being done these days.
Yeah, yeah. I guess that as well goes nicely with this question from Ola, because having an understanding of why you're taking a trade really kind of helps when the strategy starts performing poorly. So Ola would like to know, what would be your reasons for taking a strategy offline?
Well, I mean, of course, if it completely goes off the rails, that's one good reason. Ultimately, let's look at it this way: you can form a statistical profile of different performance characteristics of a strategy, and it's important to make sure that's actually conforming to that profile. And to some extent, the profile has to be a bit dynamic, because let's say the strategy was built on 8 years of data, and for some reason that 8 years of data pretty much was only one regime. It had a really static volatility, and it didn't change much. And you're making $10,000 a year on average, and you have a $3,000 drawdown. Well, if all of a sudden, if something happens and the volatility skyrockets, you're not going to conform to the profile, but if you're mindful of the fact that when volatility increases by 3, you should expect your profits to increase proportionally. And it's not impossible your risk could increase proportionally as well, and you're still okay. So there's the first question is it off the rails? If it's off the rails, you put it offline until either it comes back, or keep an eye on it. Or if it doesn't, if it's kind of gone way out of profile, you need to know why. And if there's a reason for it, then you would not take it offline, unless of course it's going off. If it's going off the rails, then you would anyway. But then there's another reason. I mean, what if you're looking at 50 markets, and our cotton model, for example. I haven't looked at cotton hard for a while, because that's not really that important of a market to us. But it tested extremely well. It's done very well on a sample, but it's kind of flopping around the last couple of months. So the question gets to be, if a market really just completely goes flat, where it gets to be way too volatile in a very erratic kind of way, that could be because you may have other markets or other strategies that are performing better. So then you take one of them offline and put the other one online. The same thing goes for if you have, we have in one of our portfolios, it's got 45 strategies for the S&P. Well, we don't need all those, so we're looking for the 10 best, and that changes from time to time. So there's a number of considerations. Some of which are those.
Yeah. And if that happens to a strategy, would you look at readjusting it, or do you, as Ola mentioned, ask here, how often would you readjust a model?
Well, all of our models are based on walk-forward analysis, so they all need parameter updating at periodic intervals based upon their walk-forward parameters. So that's something that's just built into it. It just kind of depends. The reason why I'm an advocate of having lots of strategies is because it's having lots of strategies that are uncorrelated gives you a much better chance to take advantage of any kind of market condition that comes along. So, if a strategy completely fell off the rails, and I only have one strategy, I guess that'd be a problem. However, since we have more than one, usually we have something else to take its place. And I know some of our metals models the last couple of years have really not been having a great run of it. So I think you simply have to look at the cause of it, and if it's the strategy, then be aware of that. If a market's really moving and you're not making any money, and something's wrong with your strategy. So I think you have to kind of look at the reason, and you look at how far it's fallen, and if it's really fallen, really, if it's taken a really hard turn for the worse, I guess you really have to look at whether or not it can be. It can be repaired, but maybe it can't be.
Yeah. Okay. Another question here.
There's no hard and fast rule. What I'm saying.
Right. Okay. Thanks, Bob. A question here from Al. We're going to start wrapping up in a moment, but this one from Al. You mentioned using neural nets to find support resistance levels in price. Can you do the same thing in time? For example, change of trend.
I don't see why not. I haven't done it, but I don't see why not.
Okay.
And that's the thing, a lot of people, people who study GAN and so forth, really talk about just using time cycles. And ultimately, if you have a technique for finding these kinds of things, yeah, I can't see why a neural net couldn't do that. It'd probably be more difficult to set it up. But.
Yeah. Okay. Got a question here from Adam. Actually, I noticed Adam in the chat said, "Don't do it, Bob, when you're talking about shooting yourself in the head or using walk forward." So please don't do it, Bob. But this question from Adam. Sorry?
I'll try not to.
Okay. Hi, Bob. Do you like short-term correlations or entire history correlations? I've found that as you shorten the period, a lot of stuff tends to get higher correlations.
When you say entire history, you mean, for example, looking at like the last 10 years of a market?
Yeah, I guess that's what he means. Yeah.
Yeah. Well, I think that short-term correlations they happen, and they can be a two-edged sword. I know that in the crash in 2008, our program XT99 had like a year that was just unbelievable. It made up about over 140%. It never even had during that entire time period. It never even had like a 10% drawdown. And the simple truth is, all the markets trading off the stock market, they were all correlated to the max. And you couldn't. I don't think you could find anything. I don't think you could find any uncorrelated markets. I don't care how hard you look in a situation like that. So, in that particular instance, it served us extremely well. But I think what you have to do, if you found, for example, you had, let's say you're looking at 40 different strategies, and unless they in the perfect world, they had no correlation whatsoever to each other. If for some reason, in the last 6 months, they all got correlated to the max, then you better be aware of the fact that happened, and you better be much more careful. You might be much quicker to pull the plug if things start going south on you, because that certainly can happen. And when everything is correlated, you're really trading one thing. And if you're making money, it spends. That's great. But if it goes against you, it can be very damaging. So you have to be very aware of the fact that you have the correlations, and figure out ways to lighten up if you need to.
Okay. Question here from Ilya.
I don't like correlations at all. So I don't like them in any way, shape, or form. I like completely uncorrelated things. There's no reason to trade 5 strategies that are correlated on the same market, in my opinion.
Yeah.
Unless you need capacity.
Okay. Great. I'm conscious of our time, so I might just ask 2 more questions here, and then we'll have to wrap it up. This one from Ilya is about walk forward. Let me put it on the screen for you to see. You love to talk about walk forward techniques. Can you give some concrete examples of objective functions that are reasonable to use?
Well, honestly, I will keep that proprietary. But let's put it this way: what I have found is, if you have a very good strategy, the objective function doesn't really matter. They actually all will work pretty well. That's not to say, for example, you can't build an extremely sophisticated way looking at your optimization stuff, which would kind of go beyond a pure objective function. And personally, I think that most of the objective functions I used to think they made a difference. I mean, I actually like to use PROM, pessimistic return on margin. But I found that if the strategy is very, very good, it doesn't matter that much.
That's an interesting observation. Thanks, Bob. Okay, a question here from Remy. Do you recommend diversification through a portfolio of strategies or instruments and markets?
Oh,
both. Use it all.
Use
it all. Well, I mean, do as much as you can.
I think that ultimately, if you're trading, considering that a lot of stocks are highly correlated with one another, and given that a lot of markets the energy markets are going to be correlated, you have a lot of correlation among markets, and as I pointed out earlier, you can even have massive correlation depending on market circumstances. The best defense is a good offense, and that is to have a whole lot of different strategies that are uncorrelated trading the same market, and have portfolios of let's call it a market. Let's call it a strategy portfolio on a market, and then you'd have strategy portfolios on a number of different markets. That's the best of all possible worlds.
Yep. Okay. One more question here. We'll ask this one from Sabi because Sabi has asked a few times. Which asset class is the best for machine learning? Can you use ML to predict FX pairs?
I don't think that machine learning is actually at all. I don't think it's got a bias for any particular market. I think if you have a sound machine learning, I think if you simply have a sound machine learning process, it should work in any kind of market. I don't think there's a preference. Let's put it that way.
Yep. Okay. Now, I think I said that was the last question, but I've just seen another question here that I really want to find out your response to. So this one's from Ola. Okay. Ola's asked some good questions today. So let's use this one as the last one. Final question of the day. Do you use feedback in your models? For example, do you use the equity curve as input?
We look at performance in all the models in a very algorithmic way in a lot of different dimensions. So, and the equity curve would simply be, we don't look at the equity curve overtly because we're looking at a much more detailed level of performance in the equity curve. But one thing I will point out to you is if you like to look at equity curves for input as to performance, I don't know if you're much of a fan of Elliott wave or not, but you can actually apply indicators, for example, to equity curves, and that's very useful. And you can also look for Elliott wave patterns in equity curves. And as odd as that may sound, it's actually relatively meaningful.
That's interesting. Never thought of it like that before.
It's pretty wild, when I first started doing that, when I first started looking at that and saw this, I thought, wow, this is really wild. Because I've always been, I believe the markets are basically a human process, and they're as a human process, they're measurable, and they're analyzable, and they're quantifiable, and they can be dissected and analyzed in a scientific way. So to see that actually the equity curves actually conform to the same kind of thing just confirmed that belief of mine, that ultimately and of course it depends on the equity curve, because you can have an equity curve for a portfolio, and if it's done well, and it's not gonna have a lot of patterns. It's gonna basically just be kind of like this, or I suppose go like that too, but not for very long anyway. But if you have a really good, so you have to look at what the nature of the equity curve is, and so when you look at equity curves for a portfolio of uncorrelated strategies on a particular market, you're going to have less pattern in it than you will if you're going to look at an individual equity curve.
Yeah. Okay, well, I'm conscious that our time is up, so we'll start wrapping up now. Thanks a lot, Bob. So if people want to get in touch with you or learn more from you, where can they go?
Well, our website is pardo.space, and there's lots of information about what my background and what we're doing and so forth. And people can write me emails at bob.pardo@pardo.space. And I do my best to answer emails in a timely fashion. If you write me a really long one, it may take a long time to get an answer, or I may tell you that that's something that's kind of that's no longer, that's kind of past the point of getting a free answer for. But I'm usually very responsive, and I'm happy to answer reasonable questions, and certainly anything about our products and so forth and services. That's all something we cover in all of our communications.
Yeah. Okay. All right. Well, thanks a lot, Bob. It sounds like people in the chat have got a lot of value. We got here. Ilya said, very interesting answer to your what was that? The fitness function metric, and then. Great answer from Ola on equity curve feedback, and we've got some other good feedback here as well. Thank you from Remy. There we go. Thank you, Mr. Pardo and Andrew. So yeah, thanks a lot, Bob. I really appreciate you taking some time out of your Sunday evening to talk about trading with us and share some of your 40 plus years of trading insights. Very very valuable, and so thanks again. And I wish you all the best.
Thank you. Talk soon. Be well. Take care.
All right. And cheers. And just before we go, I just want to announce that next week we have Scott Andrews from Investor Quant coming on the show. We're going to be talking about how to find and use statistical edges to improve your trading. So that should be a good one. That's next week, Sunday, 7 p.m. Central. So hopefully you can join us. Then thanks again, Bob. All the best. Take care.
Bye.
Cheers. Bye.